Interest rates are down. Cap rates are even lower. The multifamily industry is just exploding in prosperity and profit. High occupancies, rent growth, low supply, high demand. We wish this was the case. Unfortunately, all that took place back in 2021. Different story today. We're seeing the early signs of distress and fear in the multifamily industry, as well as commercial real estate, but multifamily in particular. We're going to be breaking down some interesting articles today and discussing just that. What are the immediate causes of concerns? What you can do about it? How can you position yourself? But also, what are the opportunities that are in front of us? How Great Capital and our team, how we're positioning ourselves to take advantage of the opportunities today, and then as well, the opportunities that are going to begin to emerge next year in 2024. A couple pieces that we're going to be discussing on the report from the Mortgage Bankers Association quarterly survey of commercial multifamily. We're going to be talking about the banks. I'd like to hear from the MBA to see what they have to say, what they are forecasting. Also, back to the fundamentals from RealPage. After a rapid cool down, apartment rents seeming to have plateaued. Well, we got to get through the winter, but so far things are looking not horrible. From Cushman & Wakefield, got their multifamily monthly update, preferred equity update. We're going to be talking a lot about preferred equity and how it is really sitting in a sweet spot of risk and return and an incredible amount of demand from not just investors, but multifamily operators as well. And then from Reuters, U.S. regulators agree to ramp up oversight of systemically risky non-banks. A lot of the debt's not just coming from banks, it's coming from non-bank lenders, private equity firms, hedge funds. Biden administration asking some questions about it, looking at possibly regulating it. They, of course, they know what to do when they're going to regulate something. Always is really good for the economy. Also a piece from Multifamily Dive where they asked yours truly a couple questions and we gave them a response. We'll learn about it more. So if you're a multifamily investor, active, passive, you're in the industry, you're just kind of casually curious about the whole multifamily space. Fortunately, you're in the right spot. Great Capital YouTube channel, specifically the Great Report, breaking down all the latest research reports, the new data, articles, opinions, and just the happenings of what's going on in the multifamily industry, commercial real estate, residential real estate, and the macro economy, giving you the best information to help you make some really well-informed decisions, especially in these uncertain times, trying to clear things up a little bit, given that we don't have a crystal ball. Dr. Matt Boston, our Gold Director of Communications and Marketing here at Great Capital, producer of The Great Report, is joining us in the Great Capital studios in, I would call it overcast, Indianapolis, Indiana, in the heartland from the Midwest. All right, we got a great show. Let's get into it. Welcome back to The Report. Dr. Boston, how you doing?
Oh, pretty good. Pretty good this week.
It's the seasons are changing. As we've mentioned before, I've been on the road this week, but talking to a lot of owners, and I'm talking to a lot of lenders as well, a lot of people in the industry. And, Matt, we've talked about this period of kind of max Q, or max pressure that the industry is going to be going through, starting, in October. And we put that report out, first back in June. Identifying this period of time where the industry is going to start, again, experiencing a lot of pressure.
We had to wait for it to come true.
We did. It was more like early, November, but more and more today, we are hearing stories of multifamily investors and operators, whether that's, limited partners in a deal and a syndication that is essentially going to zero. They've lost everything, or conversations of foreclosures. I just was reading a report, Matt, of office foreclosures, not multifamily, I'm talking about office. And, there are keys, being handed back to the bank, more and more every single day. Yeah. Not happening as quickly in multifamily. The default rate is still relatively low, but with these higher interest rates, high inflation and expenses, and subdued rent growth, it's created a recipe that if you were a buyer in the last several years and, acquired a deal that, needed a lot to go right, not all of that has gone the right way, and you might be in a troubled situation. Yep. Now, there's a lot of opportunities out there that we're starting to see in kind of untraditional ways, but, the market has changed. We've heard this concept of the Great Reset in the economy, and specifically for real estate. We're still transitioning through that. but we're not out of the woods just yet. And Matt, the question that you were asking me and what we were discussing before beginning of the show is, a lot of people are trying to call the bottom. You know, are we there? I think CBRE said that the bottom was a couple months ago and cap rates stop expanding. Before we get into the Mortgage Bankers Association piece, what's your take, Matt? You're researching this stuff every single day. Are we at bottom? What are the experts saying?
I don't think that we're at bottom. I don't think that there'd be this discussion about like all these alternative solutions to funding if we were at bottom.
Yeah. No one's cried uncle yet, right?
Yeah. No one has cried uncle, but we have had a lot of things that are starting to happen that can't but otherwise be people that are being put under pressure because of the stuff that we were talking about, whether it's multifamily loan maturities themselves or the bare fact of persistent high interest rates, or which we've also talked about, like an inoperable investment plan that's not working because you didn't get the rent growth that you wanted or that you planned for.
Well, unfortunately, there were the whole breed of buyers that their business plan was further cap rate compression and cap rates staying low, and the opposite has happened. So then if you also don't get that rent growth, that's kind of a double whammy. And then if you've got a loan that's coming due, you're so far off the mark. And the reality is, there's a lot of deals where, there's, $20 million, there's a $20 million loan on the property, but the property's only worth $15 or $18 million.
Yeah.
And so that creates an issue. It has to be restructured. The bank is going to probably have to take possibly a little bit of a hit. Other cases where they can just work it out, but they need an injection of capital.
Yeah.
And where's that going to come from?
That's what I was thinking. For every dramatic example that you do see and that we have seen, there are a dozen examples of people that it's not maybe, huge blowout, but it does mean that they're going to have to make hard decisions that they would not have otherwise made. And that means either going to, preferred equity or going and maybe trying to put it on sale or something. They're looking for things. And if everything was looking like it was normally, then maybe I could believe that the market has hit bottom. But the fact is like people are looking for more expensive lending. And how is that going to lead to more expensive apartments? Usually when interest rates go up. And again, like this is all based on another prediction about 2024. And I think that there is so much willful blindness or just negligence of the fact that we will have a challenging 24. It's not going to erase any of the struggles.
It's all going to be good.
Yeah.
It's going to be fine.
Here's the thing. It's going to be just like a little bit normal. I think it will be slightly better than 2023.
Okay.
A little bit lower than historical averages, but not enough to get the growth that will justify this narrow gap between interest rates and cap rates right now.
I could see 24 being pretty slow. I think normal growth, I think is, I don't know if it's base case or it's optimistic. And we may see that through 24 and halfway through 25, to be honest. Yeah. There's the reality that, it's almost like time was compressed during halfway of 2020 through, 2021. We had, 5 years of growth, or in many cases, 8 years of growth in 18 months or so. Yeah. As time expands, now it's going to refract. Now it's almost in a time or a scenario where we're seeing, time slow down and that growth slow down. The time compressed. Now it has to expand again. And it could be a little while of just slow growth, but here's the upside. So this all sounds really, doom and gloom, but the reality is, so the financing is drying up for all these development deals. We're building a lot right now, but we're still digging our way out of a hole from enough housing units and specifically rentals, where renting has never been made more sense relative to buying. There's a huge demographic that is, it's forming households right now. There's a lot of household formation going on. Wages are, growing, nominally relative to inflation. We've actually are seeing some decent wage growth. Yeah. So a lot of the fundamentals for apartments are really solid. And
it is the most attractive investment type. Like there's several studies out there that talk about like, no, this is a really popular asset class. People are pouring into it. There's a couple Globe Street articles out that talked about, oh no, their capital is flowing back into multifamily. Now, I would read that with a great big asterisk, but But again, there is attention that's being paid for of the property types. I'm guessing that people think that multifamily probably has the most legs, has the most like stability.
It's there's a couple transient events. Can borrow a term from Mr. J. Powell. I mean, the supply onslaught, which we have pretty good insight into, what's coming down the pike, as well as what is being turned off, as AKA financing for these construction projects. So it's hard to start a project right now because you can't get financing.
Yeah.
So we know that there's light at the end of the tunnel, but right now today there's too much supply and interest rates are too high and there's no growth. It's kind of a triple kind of death blow for a lot of deals, especially if you were counting on certain assumptions. But who's willing to the smart investors are going to find opportunities now at a good price. There are not very many, if any, of those out there. But to get to 25 and 26, then the question is, now do you look? You have to always be looking for deals. You can't. As I forget who said it was, I think maybe John Seabury from Marcus and Millichap. No one's going to call and tell you when that market is bottom and when the deals. You have to be in it. No, the deals might not make sense, but you have to be an active participant. You have to be making offers. You have to be communicating with brokers and owners.
Especially because I think that the market is just much more competitive than it was pre-pandemic. Like I think that you've mentioned this before. I do think that ultimately the cap rate is going to end up on a lower than 2019 side. Once everything kind of the rubber band effect in the wake of all this movement, it will probably end up because people have poured in so much people and they're not coming back out.
I think it's gonna I don't know if we know where the peak is. There's going to be some probably high cap rate deals at very high cap rate deals at some point that are going to be more distressed because there's either stuff that everybody wants or there's stuff that nobody wants. And now there may just be no buyers at some point if everyone's so afraid. We've kind of gotten past the denial stage. Now I think it's a little bit more of the fear of it's like we're kind of like realizing it, but we're anticipating it. But we got a couple other stages of grief to go to flush everything out the system. But it's tough. It's tough to navigate right now.
And I think that we're seeing, signs that, there's some real pain that people are starting to feel, whether it is, that story of some.
Yeah, I heard a story of an LP. I mean, they lost everything. I mean, the whole investment, it's gone. And CRE analyst, Matt, they made a post on a couple days ago that's anticipating that the value declines, they're forecasting value declines. They got multifamily value declines estimating, close to 40% potentially
over next year from now. I
forget what the time period is, but basically, and that's where like the bottom, may be.
Okay.
And in that scenario, equity basically is taking a 50%. Haircut in multifamily. Now, that's only if you have to transact, like you have a loan coming due and you have to realize it. That's the kind of the sort of the magic thing about, illiquid investments is, paper losses and paper gains. We didn't take some big paper gains, with pricing of 2021. Well, if you're not selling, today, you don't have to realize that higher cap rate environment. And if you structured your project where you can have a longer term hold and you can, select your time of exit or have more flexibility, we're not marking to market, these assets every single day. You can, but, it's not real. You're not actually realizing it. But if you have a structure which you have an expiration coming up and you have to have a capital event, you may be in that scenario where things aren't turning out the way that you wanted it to.
Yeah.
And the reason why multifamily became such an attractive investment asset class over the last couple of years, was the stability.
I remember this was one of our sales pitches.
Oh, yeah. 100%.
We're insulated from the vicissitudes of the crazy market, of the crazy stock market.
True, but the stability that I'm specifically talking, that is true.
Yeah,
and that is still true. I mean, the private investments. I mean, look at the REITs. I mean, they're way down now. They may be projecting where things may be going. But again, we don't have to necessarily you don't have to necessarily realize it. The reality is, man, even deals, some deals, and we were talking to a bank and a lender that we work with a lot, and he said they were meeting with Freddie Mac, and there's a lot of deals, not just the bridge loans, but there's deals that originated 7 years ago that are underwater.
Oh, weird. Because I would think that, the ones that it was the flurry of 2021.
I know, me too.
Wow.
Me too. That's how bad it is. And Freddie Mac, they're trying to develop their own preferred equity program because they know that there's these large equity gaps because of all the maturities that are coming up.
Yeah.
They're trying to find solutions. Everyone's trying to, find, the right tools to kind of, bridge this gap to where, interest rates will become, lower, hopefully, maybe. Again, it's hard. You can't really count on it, but, if you don't have a choice, I guess it's what you can hope for.
Yeah.
And for growth to pick back up.
Yeah. I mean, there's a lot of hope that if you look at things if you look past 2024, it looks great, but there are specific due dates, and these are due dates that maybe could have come along a little bit beforehand, or maybe people should have been worried about beforehand. But I think that maybe they waited because there's no use, no use worrying about it today and having to have that difficult conversation with your investors today when you can just wait until the maturity happens, or the week beforehand or whatever.
Let's make it the bank's problem to figure out, hey, you're not getting your money back. You have to work with us here.
Yeah.
Let's hop into this Mortgage Bankers Association piece. Quarterly survey of commercial multifamily happenings. Quarterly survey of commercial multifamily bankers originations Q3. It's not up, it's probably down. What's the
it's not a full report as much as just like a data release, but this data on CRE
here. That's why folks are here.
That's right. We can break it down for you. But to be honest, this data really just confirms what we've already been going through. The numbers give you an idea of the scope of the issue, and it's good numeric proof of this clear change that we really have lived through. We've noted and discussed and really cogitated upon, and to see
what are we on?
Cogitated. And really just to see it laid out here is really effective, and it puts things to the test in a way that you really don't see. And that graph is specifically is what I was thinking about is you can see how much the originations have changed from 2020 2021 where they Q4 where they really peaked to 2023, and really we're not at the 2019 rates at the moment. We are currently hovering around the 2015 rates of originations. 2023 is equivalent to, and that's not even accounting for like interest or for inflation or anything. Naturally you would see this increase, but we've really kind of backslid, and specifically it's multifamily originations are down 50% from last year. And if you do the math, they're actually down like 41% from the pre-pandemic 2019 numbers. So that kind of gives you this idea that like, oh, even in a normal pre-pandemic era, we're only like 59% of where we should be. And I would argue that the increased competition from investors should mean that we should have more. We should have a bigger number there, but we're just not there. And I also think even more broadly, it's interesting to see how other CRE sectors have gone through a similar process in the past 3 years. There's a few instructive base effect examples that you can see too that show how a large decrease one year can make an increase the following year seem so much larger. If you scroll down to this table that they have, where they have this information, and I'm looking specifically at hotel. So in 2020, hotels, there was a 94% decrease from the year before. And then the following year, 2021, there was an 866% increase in loan originations. So, but really, if you're going with that 2020 number, so you're going from like 6% of the 2019 number, and then after that 86 the 166% increase, you're really at like 58% of the 2019 numbers.
Yeah, exactly. Yeah. Exactly.
So, the big numbers following the big decreases, and it's just really interesting.
A little bit of a swing right there.
Yeah, it is a huge swing, and it does seem like, you can...
And now they're down 52%.
Yeah, well, and the other interesting thing here is for all these sectors, you see the big swing up in investment in 2021, and then it dips down in 2022 and down even further in 2023. Except for healthcare is this weird exception.
Yeah, healthcare's
where it actually, while everyone else sank, where everyone else dipped down in 2022, that was where it peaked for the past 4 years. So it was, it didn't have as big of an upswing in 2021, but it had a big upswing in 2022, and now
it's having a big fall off.
Yeah, now healthcare has the biggest fall off in investment of all the sectors. So just strangely different timing, because you would think that 2022 would be more subdued due to interest rates, but there must have been some other pushes there. I wonder if there was some more increased investment projects that got started in 2020.
Yeah, I was going to say it could have slightly different, drivers.
Yeah,
and not, the pandemic may also have
exactly
played an effect, and
like let's get more built and that kind of thing. But
we have to build we test the COVID testing centers everywhere.
But ultimately, the picture of this is one of reduced transactions. No matter how you slice it, we are, we're seeing lower transactions, and it's it's hard not to think that it's from the higher interest rates. And I also think, and we'll see this here in other in other articles, that these higher interest rates also accompany like a more stricter position from the banks, and a greater. You kind of alluded to this, but a greater awareness of the of like the riskiness of certain assets. Now, if we can skip ahead to the Reuters article, I think that hits on the nail on the head, really, of this idea of risk and where the banks are when it comes to risk, and where, even more importantly, I guess, where U.S. regulators are. The headline here is U.S. regulators agree to ramp up oversight of systemically risky non-banks, which I think that's some pretty powerful implications behind this vague non-bank descriptor. So it seems a little harmless, but they're basically taking aim at a large group of people and institutions that provide money to others, but aren't technically classified as a bank. And this is one of those things, and I was talking to you before recording here about, I'm kind of confusing myself if I think about it too much, because there's so many things that a bank lender does that are pretty similar to an investor. I know that there's a different position in the capital stack, different risk rates, guarantees, but like a bank is kind of doing, they're giving money today in exchange for money later.
One's got a charter from the Federal Reserve.
Yeah, and I think, that's what I was kind of anticipating. It's like the key difference there is it has the kind of imprimatur of the government and has that officialness, and which also comes with regulations. And I think that the
Federal Reserve's the government.
Well, the government. I'm
joking.
Sort of. Not really. I would put it in the same box, but it's
gotten the license from the cartel. They've gotten the thumbs up.
But like it just does, like, it gets me thinking about this fuzzy line between private investment and a more strictly regulated bank, and what rules the banks are required to follow, and the capacity of these banks to follow the rules. And I may be speaking out of turn here, but I think the open implication, and I've got a couple more paragraphs in my notes here about it, the open implication is this going to be a case where the big non-banks are going to help the regulators set the rules, and then the smaller non-bank lenders are going to be kind of cut out of it, are not going to be able to operate like they wanted to, which seems counterintuitive. If you're trying to reduce systemic risk, wouldn't you want that spread around more smaller banks that have?
How is Jamie Dimon going to,
Yeah, that's true. He's got
grow JP Morgan, Chase, another, $1 trillion in assets or whatever.
Yeah.
That's not going to help. That's not going to help him.
Yeah.
That's as simple as that.
Yeah. Yeah. I don't know if we've seen
Get out of our way. This is our turf. We're getting our the hired thugs in the Biden administration to come and crack some kneecaps.
It's not as if their worries are not like completely out of place. Of course, you don't want people to be fleeced. You don't want the markets to collapse. But also, like, I feel like if it's diversified under a number of smaller decision makers, rather than having like this monoculture of you know what I mean?
Yeah. Well, so here's the concern, and it all comes back to uncertainty. We don't know, and we think people are making money over there. Let's go figure out what they're doing wrong, and some are probably doing some wrong things. There's bad actors in every industry, and mistakes are made, and that's why like in a market, and we don't have a free market, but like the idea is that winners are rewarded, and you make some bad decisions, and you're not. Doesn't work like that if you're too big to fail. But the idea is that if you're not banks are regulated and have to follow certain rules. They're given a charter, by the Federal Reserve. They're getting access. They're straight. I don't know another better word to say this, but they're right at the teat of the Federal Reserve. Yeah. They're the closest, the ones to it. They have access to this capital.
Yeah.
Access to the Fed, and they have a lot of rules. And then post Great Financial Crisis, when Dodd-Frank was passed, they classified certain large institutions as essentially too big to fail, and they have even more rules that they have to follow. Limiting on what banks can do, what they can invest with, the reserves they have to keep, the activities that are permitted and not permitted, and then it's a lot of rules and regulations. Partially because the big banks can afford to deal with those, but because they're so heavy-handed on the regulation side, it would have crippled a lot of the medium and small and the regional banks. So there's not as many restrictions for the non-systemically, the too big to fail institutions. But they're still banks, so they have to report. There's still a lot of regulatory requirements, reporting requirements. I'm not going to say that I know every single one by any means, but that doesn't. You don't have to be a bank to lend money, though. So that's where it's like you assume lending comes from the bank. Yeah. But like Matt, I can't borrow $10. There's no law that says you can't lend me $10, and we have a contract, an agreement, in the basic form, just a promissory note. I promise to pay you back, and on this schedule, and there's some interest, and
it is perhaps a wider sphere of human activity that they're seeking to regulate than maybe.
Yeah, well, and I'm not okay. So like in reality, we're not talking about you and me, but I'm talking. So what they're talking about is a hedge fund, like a Bridgewater, or any of these large hedge funds. Whether it's Citadel or pick your large hedge fund, and a lot of these hedge funds have gotten into the private credit business because you can lend at higher rates, you can be more flexible than a bank, you can take more risk, and you have much more flexibility because you're not being regulated like a bank, and again, people should be allowed to take some more risk. The concern is, though, and it's a part of, I think, a healthy part of the economy that, all right, there are some players who are willing to take a certain amount of risk and are willing to accept that risk if it doesn't work out. And there's other players that, they don't want to accept that risk if they're going to take less risk. That's healthy. Yeah. But since the banks can't take a certain amount of risk, they can't get involved in certain types of businesses. They have limits of what they can do. They can't support all the demand. And so, surprise, surprise, these other lenders that have access to capital are filling the gap. And so but there can be black boxes. Again, they're not necessarily publicly traded companies. They're private companies that don't have to tell you or me or some regulators. Maybe the SEC, depending on they're not like they're not. It's not they are not unregulated. There are still securities rules, laws, fraud. All that still is in place. But the concern is some of these major hedge funds, they're so big. The concern is how big are those balance sheets? And if there's concerns at the banks with the loans that they made being bad on commercial real estate, and these non-bank lenders have entered into the space and have been making similar loans, maybe riskier loans, maybe looser loans, do they not also have potential risk? And some of these institutions are, manage billions of dollars. I mean, just think of think of Blackstone.
That's what I was kind of saying.
Blackstone's handing out debt. They're buying deals. A bank can't own. They can't go and invest as equity, in a multifamily deal. They're a bank. They can't do that. They can provide you a loan, but Bridgewater, they'll finance their own deal. That they can give themselves a loan. They can give themselves equity. They can do whatever they want. They can structure it and make the terms however it works for them. And that works, while the market's continuing, to improve and increase in value. But all of a sudden, we have an event where the values are upside down and, the tide's coming out. It's not coming in.
Yeah. And so then the risk would be, it's like the bad thing that happens is these investors, then they don't get any returns.
Well, it depends on the deal. The concern is there's a bunch of people who made a lot of loans that, probably in the billions upon billions of dollars. There's trillions of multifamily debt out there, or just in commercial real estate debt. Yeah. And the regulators don't know what it looks like, and they want to see. And the question is, and again, it's like they don't know that there's anything that's happened. But they're saying, should we have the same rules on you that we have on JP Morgan Chase?
Yeah.
And these other too big to fail institutions. So, Blackstone, you're out here buying up everything. But since you're not a bank, we can't see what you're doing. Yeah. And we want to see what you're doing to make sure you don't wreck the economy. Now, but inadvertently,
because there's so much in there that and this is what I was trying to say about like a monoculture is like, well, whatever they're underwriting, surely there's a similarity throughout Blackstone. And if they make that mistake or, and if they go down, that's a big chunk that goes down. That's billions of people's dollars. And that's going to make a big impact.
Well, every institution and endowment is, invested with Blackstone. And so, there's an argument that you can make that, is Blackstone, let me put it this way. If we're going to have, if we're going to label institutions too big to fail, are they one that is too big to fail? Yeah. It to me, it's like we're asking the wrong questions. Should the government be, labeling institutions, too big to fail or not? Or some of the problems we're having in the economy is because we haven't allowed some of these institutions to fail. Yeah. That obviously can be controversial, but, we're kind of just stacking, we're adding some like super glued to the house of cards a little bit of like, this can't fall down, but it's still pretty flimsy.
Yeah. And it seemed, and like I kind of mentioned earlier, it would seem that any regulation would dissuade the smaller banks to join in. Well, or the smaller banks from
not only that. So you're trying to avoid an economic, crash, right? And so, but what you're doing is you're removing a lender that is keeping the economy moving.
Yeah.
If these non-bank lenders weren't active during, the SVB crisis and the regional bank crisis that happened earlier this year, who else would step in? Everyone else didn't want anything to do with a bank. Yeah. It's these other institutions that were still open to business that kept things going. And so you're further reducing liquidity from a market that is getting pretty dry already because you're concerned about something that hasn't happened yet.
Yeah.
And therefore you cause the thing that you are concerned about.
And that's another question that I had here is in a sense, this discussion kind of boils down to, or like the bad catalyst, at least for multifamily lending, boils down to the assets themselves. And if the assets on banks' or non-banks' balance sheet are doing just fine, that's no problem. Obviously, we're seeing the cracks now. So then how do non-bank assessments of the market differ from bank assessments? You were kind of noting like regulators probably want to know this too. Their balance sheets and is their underwriting any different from banks? And I would think that, if we're thinking about banks on one spectrum, we're thinking about LP investors on the other end of the spectrum when it kind of comes to like risk and the difference between an investor and a bank. And so if banks are getting more stricter and maybe they are accepting a lower LTV or just kind of tightening their requirements, then I would think that the LP investors also seeing the market right now and saying like these risks are too expensive. And so is there another option? So where banks are becoming more restrictive, then LP investors are maybe downshifting in their risk and becoming preferred equity investors. Yeah. And I also thought about it as like, yes, these preferred equity are taking more risk, but they may also be more
preferred equity is taking than the bank.
Than the bank. Sorry.
Yeah.
But they're also a little closer in terms of like the information on the market. They're a little bit, they may know what's happening on the ground a little bit more closely, or at least they're just more comfortable with a risk. But I like to think if you're willing to take more risk, then you know a little bit more about something. Otherwise, if it was a guarantee, then there wouldn't be. But
you'd like to think so.
Yeah.
You'd like to think so, right?
Yeah. But so that was my thought, is that you were seeing this shift of population, the same shift that is preventing a lot of these borrowers from going to banks is also opening up an entire new group as they kind of shift into a new avenue of funding or investment or lending, however you define it.
We should allow market participants to show up and provide supply of resources.
The government never told anyone to do it. They just somehow did it. I don't get it. The government didn't even tell them.
Didn't even helping hand.
Yeah.
So it's good intentions.
Yeah.
There's good intentions. We don't want the economy to collapse, and too big to fail seems scary. And evil hedge funds out there, Blackstone. What are you guys doing? We want to know. We want to put the financial industry screwed up. Wall Street screwed up the last great financial crisis. What funny business? What pre-crimes have you committed? In the hedge fund world. In non-bank lending space, and let's start prosecuting you now and they want to tighten up the reins before something happens, but it's going to have adverse consequences and unintended consequences, and not the effect that they want when we need the liquidity. It's like, and I hate to say this, but in a disaster area, the whole idea of price gouging. Water is expensive.
Yeah.
What's the motivation to bring water into the area if you can't charge any money for it?
Yeah.
There's none.
Well, the government brings the water.
Yeah, then they don't, and everyone dies.
Yeah.
But like, if it's like there's only so much water in the area, it's going for $50 a bottle. The market hears that. Everyone and their moms coming down there with water bottles. All of a sudden, there's a lot of water bottles, and then you've got equilibrium in the market, and the water's at a reasonable price.
Yeah.
Now, that sounds like really cold-hearted, and now we're not talking about, hurricane disaster zone. We're just talking about, dollars and cents.
Yeah.
But like, don't get in the way of people supplying what the market, demands. You don't know.
Yeah.
Like the Biden, who's even? Anyway, we don't have to talk. Who's making these? Janet Yellen. Kamala Harris, but Joe Biden's not making any decisions. He's not making decisions.
Yes, well,
he's not making decisions. So, you got Janet Yellen and Kamala Harris.
Well,
God.
ultimately, if we're talking about these regulations,
We're allowed to talk about that?
I don't care.
You don't care.
No, but I honestly, though, like, you're talking about who's making decisions. It's hard for me to think of any other person that would be making decisions other than the leadership in the largest institutions involved in here.
Yeah, so
the largest.
Jamie Dimon is making the decisions.
He's going to be determining the regulation, just in the same way that all those AI behemoths were coming up to Congress.
Exactly.
Regulate us. Well, yeah, they're going to shut the door behind. And
here's what you need to do.
Yeah, it seems like they're targeting themselves, but really they're protecting themselves, and that's it's happened a lot of times. And
don't worry, everybody. The government's here to help.
Yeah.
And Jamie Dimon.
Here's some water bottles.
RealPage. Are we going to go to this RealPage?
Yeah,
piece?
this is a little bit
pop around, or
let's do the RealPage, because I think it's a good. It's a nice palate cleanser, I guess. It's a valuable update, I think, on apartment market fundamentals after we've talked so much.
And I do need a palate cleanse. Is this like a ginger type situation, or is this more of like
this is more like a sorbet. Yeah, it's definitely a sorbet. Because I like sorbet. It's hard to avoid the fact that it is cold. Whether we're talking about seasonal rent, whether or the rent growth trends that we're seeing in October 2022. Granted, they do say that it's a plateau, but we are still following a seasonal rent growth decline that's more pronounced than average. And as RealPage describes it, beneath this headline number, which is essentially year-over-year rent growth stayed just about above average, like 0.1% above average. It was like that in in September and October, so there was no movement there. But it is a little more complicated around what's called the base effect. And he says on a month-over-month basis, effective rents actually fell 0.56% in October 23. That's a lot.
Yeah, that was a big dip.
Yeah, and compared to a 0.54% cut in October of last year, those two are the deepest for any October since the Great Financial Crisis. Really big, but ultimately, if you pair this with recent information from Apartment List, there is a suggestion that this winter we're going to see a smaller seasonal decline than we did the previous year. And is
that El Nino? Is that what they call that?
It could be El Nino, La Nina kind of thing.
Or is it's a La Nina?
Yeah. I'm not sure exactly, but I'm glad that you've pulled up these largest year-over-year cuts. And I was actually paid attention to the top markets for year-over-year rent growth. And as a story of, now they're connecting this and very validly, I think, to the construction that was going on, and specifically Midland, Odessa is this. For a significant period of time during the pandemic, it was at or very near the bottom for rent growth. And you can see now they haven't built any apartments. It's 0.0% construction rate. And they're leading a year-over-year effective rent change by about 4.5% over the next one, which is Springfield. But essentially, there is a cause and effect. The previous rent growth patterns, if they had stagnant rent, builders didn't build there, and now they're kind of coming up. That's not true across the board, but it is true largely if you look at the correlation between the construction and the effective rent change.
It's something that I know Jay Parsons has talked about a lot. We've been talking about a lot, but supply, he says it right here. It's all about supply. I mean, that is the biggest impact to just apartment operations this year. I mean, every market is affected with more supply than it is seen, historically. And so, you've got a lot of nice units that are coming online at competitive pricing, and it's really in favor of the renter. So it's a great time to go negotiate a lease on a nice new apartment building if you can afford it. And the rents are cheap. Especially now, if you want to scroll down, if you're going at some of these hot markets like Boise, Idaho, which was going crazy. But now I saw that guy. I mean, that was like that was too hot. Flew a little too close to the sun. Yeah, and for a market of that size too, it's and Austin is a little similar. Although that's probably a larger market than Boise. Although both of them similarly have about 14 to 15.5% of their inventory is new construction, and their effective rent change was about 6 to 6.5% decrease year over year. That's a pretty big number, especially considering the average is 0.1. Is about 0. Yeah. Now, again, as a renter, there's competition. Yeah. But, they experienced, 30% rent growth. So, a decline of 6.4% is nice that it's not increasing. It's gone down a little bit. It doesn't seem cheap to anybody. Yeah. And that's where, we're here saying that it's never been a better time to rent compared to buy. It's just a hard time to get into real estate, no matter from what angle, really. Yeah. It's not cheap anywhere. But fortunately with apartments, you have to have a place. People need a place to live. Yeah. There's, it's relatively inelastic demand. There's a decent amount of household formation going on. So that's where the fundamentals, make sense. But just you got a lot of new units coming online. There's it's a competitive market. Yeah. It's a competitive market. And it's definitely been shown how all of these, even the ones that are growing and the population are growing, they have been impacted materially by the fact that they've built more apartments, and I'm sure that they'll grow out of it. And I think a lot of these have had huge supplies probably in 2022 in addition to this year. Especially the ones that kind of caught fire early and were even popular beforehand, like Phoenix. There was and there's still a huge Sunbelt story in Atlanta and stuff, and like that. Before the pandemic, and remote working was this big thing. People were still talking about moving. That was the big source, is go to the Sunbelt, and I'm sure that
that they have just had such an increase upon an increase that has helped them too.
Everybody had kind of the same idea of let's go build in the Sun Belt, and it will, the properties, the thesis will work out over time. It's just it may have to change hands a couple of times. A couple of people may have to take maybe an L or not a big W, a lowercase w. But just this paragraph below this graph, Matt, I think really encapsulates a lot of it. I thought I was going to sound smart by saying all that, but in the high supply areas, lease-ups are having a bigger than expected impact on even lower priced apartments. Occupancy has declined in all asset classes, and in turn, rents have fallen. That pattern appears likely to continue through 2024. Heads in beds is the industry mantra these days, which means operators give on rents in order to protect occupancy. We'd rather have, $1,200 coming in than, my rent was $1,500. I'd rather have $1,200 than zero.
Yeah.
In that unit, because when you go a week after week after week and you don't sign a lease, you start to make some of those decisions. We just need more income coming in. Okay, we're definitely not going to hit our budget. Certainly not going to hit our budget if we're sub 90% occupancy, and that's just the case with a lot of these operators. But again, on the positive fundamentals, the next piece, Matt, is talking about, again, wages are actually outpacing rents.
Yeah.
And so it's setting, again, the renter is in a relatively good position. It's setting the industry up for, again, a really good position in 18 to 24 months. So on the plus side, October will almost certainly mark the 11th consecutive month where wage increases outpace rent increases, a trend that'll likely persist through next year. And that could erase all of the rent over wage bump of 2021, early 2022.
That's very interesting.
That's big.
Yeah.
That's big. And as mid and upper income renters continue to move up from older units to newer, typically pricier units, that affordability gain should help backfill older, moderately priced units. I'm just going to finish this off. Jay Parsons just puts it really well all the time. The current supply wave extends into early 2025. After that, supply will drop off precipitously due to rapid slowing construction starts this year. In turn, occupancy rates should rebound and rent growth pick back up, though unlikely to the degree seen in the inflation periods of 2021, 2022. Yeah. That's definitely for sure.
And this is the kind of shadow over 2024 when it comes to a rent growth perspective, although pretty great for renters. Yeah. And then it clears up in 2025, not the least of which is supply trends. There are these wage trends that should only continue, barring a kind of full-blown recession.
Yeah. Yeah.
So there are some strong fundamentals. If you get to the center of it, they're not so bad. We're not at a crisis point.
No, it's just we've built a lot in a handful of places, and somebody printed too much money, and we got high inflation, and so we got high interest rates, and it doesn't mean people don't need a place to live and are going to need a place to live, and we're still imbalanced on that, Matt. I think let's shift to this Cushman & Wakefield article. Yeah, Multifamily Monthly preferred equity update.
It's a little bit kind of retracing our discussion that we had on the Reuters article and the Mortgage Bankers Association stuff.
Should I have done the Cushman after the Reuters?
Yeah, I made this mistake. We should have done this first, but that's fine. Okay, it still gives us a distinct definition of preferred equity and its use by borrowers and lenders, which we've kind of described too. It also signals the growing prominence, like I mentioned before, and I just want to use this as kind of supporting evidence that people are talking about, and this is becoming a topic of conversation and of business plans about preferred equity in the current state of things. So the quote here, and it's a little bit lengthy, but I think it's worth it here.
People are talking about preferred equity?
Oh, I think so. I think so. This is at least, and again, like I sometimes feel like my own biases and the discussions that we have at Gray Capital affect the news that I gather. But dang, if every week the stuff we talk about,
I'm just giving you insight.
The stuff we talk about comes up in the news. Like we're basically predicting the future. So it's good to know. I think that I'd rather think that than I am guided or biased in any way. But what Cushman says about about preferred equity. They said compared to senior interest rates borrowers were able to obtain prior to 2022, preferred equity may at first seem expensive. However, the cost of preferred equity has not changed meaningfully over the last year, while senior interest rates have continued to rise. In the case of agency loans, the borrower has the choice between preferred equity behind a Freddie Mac or Fannie Mae loan. Freddie Mac preferred equity includes a hard current pay, which includes the pref investor additional rights and remedies in the case of missing a hard current payment. Now, I'm not really sure what that means, but that's
oh man, we got some work to do.
That's a little bit in the weeds. Now, Fannie Mae preferred equity is mostly soft current pay, meaning that any missed portion is capitalized and accrues without penalizing the borrower. There are fewer Fannie Mae preferred equity investors since many are focused on the rights and remedies that come with a hard current pay structure. So my guess is I don't know, they like Freddie Mac a little bit more. However, there are plenty of Fannie preferred equity options, and there's little differentiation between Fannie and Freddie preferred equity at the margin. They're taking on.
When you're saying Fannie and Freddie preferred equity, are you saying this is preferred equity provided by Fannie and Freddie, or are you talking about the preferred equity that they will allow to go in a subordinate position to their?
I believe that we're talking about Fannie Mae and Freddie Mac preferred equity. It seems like they say Freddie Mac preferred equity includes a hard current pay. Now, this is actually, if you scroll down to it's near the bottom of the article here. Yeah, there we go. And it does raise an interesting question of like, so Fannie Mae and Freddie Mac are these large lenders, and they are now entering into this preferred equity instead of maybe LPs going now. And how many banks are going to be going into a preferred equity?
And that's the thing, banks really can't. They're banks.
Yeah,
they're not equity investors.
Okay, so how can Fannie Mae and Freddie Mac get away with it?
Well, they're not a bank.
Okay, but they're a lender. It's okay. It's still
they're quasi-government, quasi-governmental.
They do what they want, I guess.
Entity.
Yeah.
No, the preferred equity is coming from our non-bank lenders, mezz shops, preferred equity groups.
Okay.
And I have, and that's where I don't. Again, I could be wrong. I don't. Freddie Mac, from my understanding of like recent discussions, like today, Freddie Mac is exploring being able to offer preferred equity.
Okay.
But they're not yet. I think this Cushman and Wakefield this is an advertisement for Cushman and Wakefield's preferred equity offerings that can go behind, agency debt in the agencies. Because preferred equity can appear in a couple different forms. And sometimes it can appear more like debt. Sometimes it can appear more like actual equity that's kind of just like capped. They can be. There's a lot of flexibility in preferred equity, which is why borrowers are interested in it to fill gaps in their capital stack, because you can have the total pay, but then there can be a certain amount that's paid upfront, like a preferred return, like 8-10%. And then, but the total, coupon or the total actual payment may be 14-15%, but that difference just accrues to the back end to when the preferred equity position matures. And it can be 1, 3, 5 year, terms. There can be teeth that goes along with the preferred equity. So there's a lot of different varieties, and the agency, Fannie Mae and Freddie Mac, both have very specific ideas of what that subordinate debt or that subordinate capital looks like, because they don't necessarily want you to be bringing on additional debt. They want to keep the loan to value in a certain range, so it has to look a certain way. So they're like, okay, that's just equity.
Yeah, I don't know enough about the Freddie Mac and Fannie Mae offerings when it comes to preferred equity, but it does seem like apart from my recitation of all like these terms and stuff that I don't quite understand. But it does seem like good evidence that an increasing number of institutions are interested and involved in preferred equity. And I think that it is particularly interesting that it's on Freddie Mac and Fannie Mae's radar. And why would they even offer? They're like the ones that are offering the big loans. Like, what is their,
So they got borrowers with gaps.
Yeah.
And so they're specifically, and the piece that we're looking at right now, again, it's Cushman & Wakefield Wakefield piece. Cushman & Wakefield and Greystone have had a closer and closer relationship. They have a partnership. There's been talk of a merger. Probably not right now because the values are down, so the merger's off. But there's definitely a relationship. And this piece, it's essentially an advertisement for, Cushman & Wakefield, but also Greystone and their new offering.
Okay.
And so and I know this is cut off, but I'll read it real quick, so you don't have to. Essentially, it says Greystone announces equity platform utilizing Greystone balance sheet. While we're permissible as well as market relationships provide third-party equity and preferred equity solutions to Cushman & Wakefield, Greystone clients. You got to get in touch with somebody, but they're seeing is this gap in the market where they're trying to close deals, and there's an equity gap. People can't raise the common equity.
The need is there.
The need is there, and so you're seeing more and more participants. And Greystone is getting into this space specifically. Freddie Mac is figuring out how to do it. And we're getting into this space also, Matt.
Yep.
We're looking at deploying preferred equity for a variety of reasons. We have the ability to do so, and we see a really interesting sweet spot to get invested into real estate, but earn a higher return with actually taking less risk.
Yeah.
Great Capital, we're in a unique position of where we have the capital available, but we're also an operator. So, in cases where, something doesn't go, the right direction and, the asset becomes distressed, if need be, when we're working with the sponsor group and the lender to create a, win-win solution. But we have a variety of tools that we can use to kind of come in and kind of right the ship and get things moving that, some, lenders or private equity, pref equity investors, they may not have those resources or capabilities. They're really just looking at it from they're really acting as a lender and just in a different kind of risk profile from maybe a different investor base. And so we've been talking about this gap for a while, that there's going to be a shortfall, the loan maturity. You don't know, you're not coming back enough money. What are you going to do? You need to fill the gap. You go back to your investors. They may have no interest in meeting your capital call. They might not have the ability to meet your capital call. You may not want to ask your investors to make a capital call. And so people are shopping for, additional solutions that are flexible. Again, that's what's interesting with, preferred equity. So like if someone brings us a deal, we can size it to where, what the cash flows from the door, what can the deal support in terms of new capital? And we can figure out what that payment is. And then we can accrue the rest of it on the back end. So it's like, things are going to ideally improve in 3 to 5 years through a refinance or a capital event or a sale. It gives you the time, but, the preferred equity is capped. So we're taking some of our upside off the table and saying, just the total pay is, 14, 15. You're only going to pay us, 8 to 10, along the way. The rest of it comes when you sell or refinance. They don't have to pay that full boat, but then to our investors, we're getting compensated for the risk. But the total returns to our investors are higher than a lot of other deals we're seeing in the market right now from common equity. But if you're a sponsor that says, "Hey, this deal is awesome. I'm gonna hit a 20 IRR," which I think is really hard to do in this market, but people are saying they can do it. Okay, well, if you think you can do it, then we're capped at 15. That additional 5%, that flows to you and your investors. So you get more upside. Maybe that 20 turns into 22, 25 or something. Probably 22. But so it's much more flexible than just like a mezz loan, which is like always a hard pay. And it's just a loan. Here, it's 9% interest. I need 9%. Versus a pref equity, it's like we can get down to 6%. Or we can even maybe 5%. Now there's going to be more on the back end. There's a lot of different ways to structure it that can work for a sponsor, not kill the deal, allow them to fight to win. Love to fight another day.
I'm just imagining all the regulations that you could apply to those. The flexibility.
No regulations, Matt. We don't need anyone.
Well,
why?
All these options, every single thing that you said, whether it's on the back end or the front end, and all of the flexibility that is being exercised right now for people to help.
Don't do that.
We can't do that now. We got to regulate that.
No. Fortunately, we're not the size of Blackstone just yet, so I don't think we're not in the crosshairs. And the non-bank lending stuff, they're really just talking about the big guys. Again, like specifically Bridgewater and Blackstone and probably some similar firms. So I think we're in the clear.
But don't give anybody ideas, Matt. Please.
I love a good regulation.
I love a good regulation. It's just it doesn't seem like it comes from the federal government ever.
Yeah. Even on the I understand. It's easy. It's easy for me to understand. Like, okay, there's always like a good intention to some of these regulation, but man, for some of these that are the one that we kind of discussed today, it's a little too easy to see through it. And I don't know, maybe more pain will come. And the more stories we hear about investors getting burned, this story about regulation may continue to percolate and may continue to develop. So keep an eye on that.
Well, Matt, capital debt. We thought it was tight. It is getting a little tighter. Freddie Mac got some issues going on. Lender, I believe New York-based lender, Meridian Capital, a little bit of hot water. Freddie Mac is investigating. Matt, this isn't good because basically they're going to pre-review anything that's coming from a broker, which Meridian Capital was a broker. They're now going through a pre-review process, and apparently there's a bunch of things that just weren't necessarily the case. The underwriting wasn't good. A lot of numbers may have been, I don't know if there's conversations of fraud. I don't want to disparage anything, but yeah, New York-based Meridian Capital. It's almost like I've read the article, Matt. One of the country's largest brokers of commercial real estate, the subject of an investigation by Freddie Mac. The Real Deal reports, citing anonymous sources, of course, but from our own sources, this is very much a real thing. And then Meridian, who was, if you've been in any industry event and if you're a multifamily sponsor, the Meridian folks have probably reached out, to you to try to, hook you up with some debt and decently, aggressive, I'd say, in terms of what they would promise or say, maybe not promise, but say they could deliver their clients in terms of proceeds. I don't want to get into the stories, my personal stories, but Freddie Mac has been a major source of Meridian's business. Freddie Mac has characterized it as a temporary pause. They're not responding immediately to queries from BizNow. Come on, you're not going to give BizNow the deets. But an unnamed Meridian Capital broker has been put on leave. The company is working with Freddie Mac as the investigation proceeds. In a statement sent to TRD, Meridian said it is committed to compliance with industry standards and best practices. I fear what their perception of industry standards and best practices are, just knowing what some of the other New York groups, how they look at deals. Now, again, love a lot of folks in New York. I'm just saying we got some folks that are moving fast. Yeah. And
well,
this doesn't happen when markets are good.
I was just going to say that. I was like, this is the proof, right? Where the pressure's on and now you see the cracks.
Everybody, when the market's good, no one's getting hurt. Everything's fine. All is good. But it's when that, again, it's the age old saying, the tide's coming out. Who's been swimming naked? Who's been just doing stuff that makes absolutely no sense? And we're just YOLOing every single day. They're like, let's issue the loan, let's buy the deal, the numbers don't matter, just ching because the party's going to continue to go, cap rates are going to stay low, they're going to get lower, we're going to make $1 million after $1 million after $1 million. We all read, Grant Cardone, 10x, we're going to, whatever we're doing, we got to 10x it. How do we do that? Well, just maybe some mild, fraud, which I'm not saying that they're doing. I'm just saying that's something that some people probably have done.
Yeah. And I think that it is a slow moving, the slow moving nature of these maturities and stuff, and the tendency.
We're not going to get invited to their party.
Yeah,
I didn't mean to see Matt.
Well, okay. I think that it is interesting that this is a proof that the conditions leave people a little more sensitive, a little bit more vulnerable. It's a little bit more closer to the bone right now than it used to be, where there was some cushion, whether you're an operator or a broker or a lender.
Yeah.
But now, like, there's scrutiny. There is less things that are available, and things are getting. Fortunately, I think that the market is adapting, and there are other solutions out there, but the solutions come with people that they will reward people paying attention. And so, I don't know what the whole details are behind this investigation. But I would take it as the fact that this wouldn't happen if things were going great.
No, cap rates compress and they get paid back and no one would ask any questions.
Yeah.
And getting back to it, and I don't think I finished train of thought, earlier in the conversation. Again, multifamily, when everything is going smooth, and again, why people got so interested as an investment class as an LP is because you can invest in a deal and it could throw up 8%, day one.
Yeah.
And you're getting 8%, then it get up to 9, 10, 11, 12% that you're sending, annualized returns all the time. Cap rates would compress, bam, you're 2xing, your money after a couple of years. You do that for 5-6 years. You certainly tell your friends, we're going to get back to that. And because people were, getting even more than 2x, even higher than 8% cash on cash.
Yeah.
But then in the last, year or so, all of a sudden those sponsors, they learned something that you don't even have to, you can get the cash flow if you can just get to that exit. Those cap rates compress. And if you can double your money and people's money in 2 years, the cash flow is less important. And I can even, and again, this is talking to not us, but other sponsors, I can even bring on extra money and I can basically kind of fake those distributions for a year or two. I'm not going to know anything. Cap rates will compress. We'll refi, pep everybody out, or we'll just sell the thing, double their money, throw out a 30 IRR. We look like geniuses again.
Yeah.
Well, the music has stopped.
Yeah.
The music has stopped. Find a chair. There aren't enough for everybody. There's not enough money around, and people overpaid.
Yeah.
And all of a sudden, that not promised but perceived preferred return that's always going to be that at 8% ain't there anymore. And all of a sudden, best case scenario, you're getting 4, if anything.
Yeah.
Distributions have stopped in a lot of cases. There are capital calls. You have to put more money in. You assets and liabilities, not necessarily always the most sophisticated. Mr. Robert Kiyosaki, Rich Dad, Poor Dad, what's an asset and liability? An asset's something that puts money into my pocket. A liability is something that takes it out. And so all these people thought that they were buying assets because Robert Kiyosaki told you to and Grant Cardone told you to. Yep. And those assets are very quickly looking like liabilities.
Yep.
Because you're going to have to put more money in the deal and it might go to zero. So, again, everyone thought this business was easy, and there are parts that can be relatively straightforward. But these are the times when the men are separated from the boys, Matt.
I remember.
And who's an actual operator, and who's just here just screwing around, and who try to 10x a little too quick and flew just a little bit too close to the sun, and the wax wings aren't working.
Yeah, well, and I remember this was an article. I think it was from Urban ULI. This was like 3 years ago when someone was saying, this is multifamily or commercial risk, but specifically multifamily. They're not it's not a passive income. It is a marginal income, and coincident with calling it marginal is the fact that you're going to be actively involved in owning it and operating it, or you're not really doing really well.
I heard a story that's like the GP is like leaving, and it's like the LPs are trying to figure out what to do. Like, that's not what they signed up for.
Yeah.
But that is often what happens when something goes wrong. It's up to the LPs to be like, all right, we have to sue somebody. We have to how do we make this right? Yeah. And all of a sudden it becomes a lot of work. And I mean, it doesn't have to be real estate. It can be anything. I mean, I know of a deal that was, in the private credit space. It was all supposed to be diversified across a lot of different businesses, but it was all concentrated in one deal, and it blew up, and it went wrong during COVID, and tens of millions of dollars just poof, were gone.
Yeah.
And the sponsor violated the terms of their agreement, and so it's like that but where's the money? It's gone.
Yeah.
And then as an LP, you have to try to do whatever you can to get it back, but it's a lot of work.
Yeah,
it's a lot of work.
Yeah.
I'm really proud, of our team and the positions that we're in and not in right now. We're not facing a single, near-term loan maturity at all. We have more potential investment capital ready to deploy, and I think we're going to find some incredible deals. We're going to be deploying preferred equity, filling this gap. So a lot of sponsors, if you are a sponsor, get in touch with the Great Capital team. We do have pref equity available, kind of in the range of $500,000 up to $5 million. We can close quick, call it 21, 30 days, get it done. If you're an accredited investor, especially, registered investment advisor, wealth manager, this is kind of the right fit to you. We're putting these deals together. We're going to do a couple one-offs, and we're going to be launching a fund here shortly. Because if we can, if we can achieve 12% to 15% returns for taking less risk, we think that's a much more advantageous position. And the opportunity, if things don't go right and the operator fails, stepping in and taking over the whole deal, there could be an asymmetric upside to the deal itself. And then all along the way, we're building the most robust pipeline of opportunities because we're speaking to every sponsor that has a deal, every sponsor that's looking to sell a deal. We're working directly with banks, with lenders. We're a preferred operator with some of our banking partners, bring deals to us to help work out deploying this preferred equity in areas that they can't. And so we've taken this time over the last couple of months, Matt, to position ourselves to be in the front of the line for when the opportunities come, and go on the offense while protecting ourselves, taking less risk, getting a higher rate of return. But we're going on the offense.
Yeah. Well, and I wanted to mention this too. It's not as if, we talked a lot about these worst case scenarios of these kind of, I almost want to say like deadbeat sponsors that just walk away from there and leave people in the lurch. But I'm sure
there's some really good sponsors who are like
majority of the people that are even in need of preferred equity have, it's just a little slice that they're looking for. And it was,
it's a good deal.
Yeah, it's a good deal.
Even thought interest rates were going to go where they are.
Like the rise in interest rates, yes, have punished the dummies. Yeah, for sure. Like the freewheeling idiots, I'm sure they got punished, and I'm not really worried about them.
Or just overextended.
It's also punishing the people that were making reasonable decisions. They just weren't anticipating, an incredibly steep interest rate increase.
No, I mean, if you go back to 2021, the fundamentals, it's like super solid. The rates are low, the rent growth's high. A ton made sense. The mistake was the thinking that that the interest rates would just stay the same, that they would just stay so low for forever, and that things would stay in that environment, which just was not realistic and just outside the realm of real possibility. So, now again, time's refracting, things are slowing down, and we're gonna have to get through this slow period until we can kind of get back to it. But again, I think we found the solution right now for not just investors, but also sponsors and operators out there.
Yeah, I agree.
And again, Greystone's launching it now. Freddie Mac's launching something. These big groups are launching similar programs. Yeah. Gray Capital is going to be a little bit different. We're a little more flexible. We are an operator, so we really they don't know the business, but we know what it takes to be an operator and how to look at deals from an operator's perspective, and have the ability to come in, provide construction management, asset management, property management on some of these deals. That's why the banks are working with us directly instead of just shopping around or whatever. They're just coming right to us because we know what it takes, and we have the resources and the people to right the ship, or to say no, this is going down. It's a time to write it off.
Yeah.
So, Matt, a lot of exciting opportunities. Again, if you're an accredited investor, get in touch with us if you're interested in participating in one of these preferred equity deals. And if you're a multifamily, owner or operator, and you do have a gap in your fundraise, we are offering very flexible terms. And again, kind of $500,000 to $5 million. You can close in about 30 days. I'm assuming that all makes sense. Just get in touch with us. We'll send you a term sheet over, get the process started. We're hoping to do $50 million of preferred equity in the next 6 months, Matt. But it doesn't mean we're not buying deals. If we see an opportunity that makes sense for our investors, we're going to go after it, incredibly aggressively, full court. But we want to be able to offer our investors an opportunity to still participate in high returning real estate opportunities, and also just seeing the demand that is percolating and is only going to be increasing. It's why we're going down the route of kind of being in this preferred equity space. So it's going to be exciting, and hopefully be able to save a lot of deals, help and partner with a lot of really good operators, expand our portfolio, and do a lot of really good business over the next year or so.
I think so too. I think that, there's a lot of problems that have emerged in this year and probably will still emerge in next year. But it has at least been a little bit heartening to know that the market is coming up with solutions. And time will tell how robust those are. Yeah. Maybe we need more regulations.
Man, stop it. Stop it.
But
Ew,
no, I'm just kidding. I'm just kidding. I do think that it is heartening, and the fact that we're involved in it is particularly exciting. So
yeah. I mean, the Federal Reserve can use some regulations, or at least we could see what's on their books. It'd be nice. Little. I mean, they show what's on their books, but little audit. Would be nice. Be interesting.
That's a good point. What could go wrong?
Talk about too big to fail.
Yeah. Oh, I agree.
They print the money. So, all right. This was great. Matt, this was an excellent episode. This was a lot of fun. Make sure you're subscribed to the Great Capital YouTube channel. So we're doing this, once a week. We got the Complex, Katrina Greens, our director of property management. She has an awesome podcast. If you want to learn more about apartment operations, if you're in the property management world or you're an investor, you want to learn what it takes to manage one of these properties. Yeah. There's no one better than Katrina. She brings on all-star guests in the industry, deep knowledge, deep dives. It's really high quality stuff. Way better than whatever this
from all angles. Maintenance. She had someone from the apartments.com social media team talking about where she draws that kind of inspiration and all these little strategies, and there's a lot to property management, and so there's a lot of really interesting stuff that she talks about.
It's fascinating. Check it out. It's called The Complex. You can find it on the Great Capital YouTube channel, wherever you get your podcast. Check us out on LinkedIn. We're pretty active on LinkedIn. Chatting, talking. Don't send us a message. It's fine. But I'd rather just leave a comment on the YouTubes, and then you can tell us, wow, you guys are not smart. We're not really looking for smart or not smart. Just tell us what you like, what you want to hear next time. If your opinion, what's going on with these non-bank lenders? Should they be regulated to the tilt? Do they need a little bit of regulation? Am I just, way too paranoid, of the federal government in general? So I'm just knee-jerk reacting to anything that says regulation. Or our thoughts on the market. Let us know where we're wrong, what you're seeing. We're not here saying that we are smarter than anybody. In fact, we're not. We just, play these roles on the YouTube. We might also happen to have $750 million of assets under management. I think we've got about 6,700 units in the portfolio right now. That's not what's important. What's important is you smash the like button.
That's right.
Subscribe.
That's all we need.
Okay. Thanks a lot.